My name is August Peterson. I'm a junior covering domestic financials for the Marquette University Applied Investment Management program, and today I'll be pitching MarketWise, ticker MKTW. MarketWise operates a multi-brand platform of subscription businesses that provide financial research, software, education, and tools for self-directed investors. Currently, they have 12 brands: Altimetry, Brownstone Research, KC Research, Chaikin Analytics, Empire Financial Research, Investor Place, Kings of Capitalism, Legacy Research Group, Palm Beach Research Group, Rogue Economics, Stansberry Research, and Tradesmith. As of Q3 2021, they currently serve approximately 1 million paid and about 13 million free subscribers. About 51% of their paid subscribers are baby boomers, age 57 to 75, 21% are Generation X, age 41 to 56, and another 21% are the silent generation and older at 76 and above, and millennials make about 7% of their paid subscribers, age 25 to 40. By net assets, 46% have between $150,000 and $500,000, 11% have between $500,000 and $1 million, 16% have more than $1 million, and about 27% have less than $150,000. They were founded in 1999, and they're headquartered in Baltimore, Maryland. They recently merged with Ascendant Digital Acquisition Corp. SPAC in June of 2021, and I believe they have a highly scalable model with exceptional unit economics. MarketWise is a very healthy subscription business. They've boasted impressive growth in the last few years, and I believe their stock is undervalued. The company has a pretty compelling story considering that they were founded in 1999 with only $35,000 of invested capital. Since then, this is still the last layer of invested capital to date, and they've grown to over $500 million in annual revenue. They've been profitable all 20 years of operation, and revenue has grown 18 of those 20 years. Some characteristics of a healthy subscription business include revenue retention, and they've averaged 93% from 2018 through 2020, and they also have conversion rates that favor high-value subscribers. As of Q3 2021, free to paid conversion was 5%. Paid subscribers to high-value subscribers, which are anybody that spends over $600 in a year, was 38%. And high-value subscribers to ultra-high-value subscribers, which is anybody that spends over $5,000 in a year, was 34%. Average revenue per user has grown at a 26% CAGR from 2018 through 2020, and they have a lifetime value to customer acquisition cost of 5 times, implying that customers are added at less than a fifth of their lifetime value, compared with the median of 3.5 times of the digital consumer subscription industry. And this stock is also, the company rather, has had impressive growth in the last few years. As of in the trailing 12 months of Q3 2021, billings have grown 53%, revenue has grown 43%, paid subscribers 23%, and free subscribers 57%. Since 2019 to Q3 2021, I think the pandemic has obviously amplified the company's earnings as billings have increased 240%, paid subscribers 180%, and average revenue per user has grown at 131%. I think the stock is currently very undervalued considering that they're traded under 10 times their free cash flow multiple. And also insider holdings are still very high at 94%. Management is bullish that the stock is going to rebound, and I think this presents a great buying opportunity. Because of baby boomer tailwinds, the company's appetite for acquisitions, and the benefits of the sponsor's leadership, it's recommended that MarketWise be added to the AIM Small Cap Fund with a price target of $9.42, representing an upside of 57.5%. Driver number 1, the Great Retirement and Millennial Money. Globally, financial wellness solutions have a total addressable market of roughly $190 billion, with approximately 63 million self-directed investors in the United States as of 2020. I think baby boomers present a profitable tailwind for the company as roughly 10,000 individuals are retiring in America every day, and over 5.5 million are newly awarded Social Security benefits each year. I think this, coupled with a general distrust from money managers after the dot-com bubble and the Great Recession, leaves us with a demographic that carries a significant amount of investable assets and a hunger to seek investment education. MarketWise also recognizes the aging millennial generation as a significant opportunity for its future, seeing that 72% of millennials consider themselves self-directed investors, and over 10 million new brokerage accounts were opened in 2020. I think this proves that the market for self-directed investors is both sizable and growing, and it's for this reason that I've priced in a 17% paid subscriber CAGR through 2025. Driver number 2, a large and proven appetite for acquisitions. Management has touted a dramatic increase in the number of inbound inquiries since the announcement of the company's SPAC merger on March 2nd, 2021. With an excess of cash, about 35% of total assets, a capex-light business model, and a newly entered 3-year $150 million credit facility, MarketWise has positioned itself as an advantaged acquirer heading into 2022. Over the past decade, the company has boasted a highly accretive track record of M&A activity. MarketWise has grown TradeSmith from $1 million to $30 million in annual billings since being acquired in 2013, Bonner & Partners from $5 million to $110, Casey Research 12 to 25, Investor Place 28 to 67, and most recently Chaikin Analytics, which is yet to go from $3 million in annual billings. And the company also has an impressive track record of building companies from scratch. As you can see, Palm Beach Research has grown to $120 million since being established in 2010, Omnia Research to $30, Empire Financial Research to $32, and Ultimate Tree to $7 million. Following this track record of exceptional capital allocation, coupled with the expertise of the Ascendant Digital Acquisitions Corp team, MarketWise is well positioned to acquire and scale many new customers to newly established financial wellness solutions. Driver number 3, Ascendant's expertise in the attention economy. Prior to their SPAC merger with MarketWise, Ascendant was seeking to leverage their team's skills and extensive industry experience to add significant value to a company in the attention economy. And I think the value of Ascendant's team comes from their depth and expertise in data science, AI, and machine learning. 6 of the 7 team members each have decades of experience in consumer-facing businesses ranging from online retail to AI-based consumer software. And I think this is very important for a content-based subscription business like MarketWise, because you want to be able to tailor your content to your consumers and show them the right things at the right time in order to drive retention and conversion rates and things like that. And management has stated that Ascendant's focus on the attention economy has already influenced the company to expand its team of data scientists and engineers. In its first public quarter, CEO Mark Arnold stressed the importance of being data-driven and leveraging real-time feedback for campaign efficiency and using AI to improve MarketWise's efficacy. To reach an intrinsic value for MarketWise, a 10-year DCF model was created. I've used a terminal growth rate of 2% and a risk-free rate of 3%. 3% partially because of my opinion on the Fed raising rates higher than expected, and also partially as a hedge to the high terminal growth rate of 2%. I've also used 2 WACs in this DCF, one from 21 to 25, which is 11.93%, and that uses a beta of 1.36%. I got that beta from averaging SPAC peers that have went public in the last 2 years. And then the other WAC I used from years 26 to 30 is 9.5%. And the only inputs that I've adjusted in this calculation is lowering the beta to 1, which I thought was appropriate because being 25 years into operating and 5 years publicly, I think it's appropriate to apply stable company characteristics to MarketWise. And I also changed my premium. I have a brand recognition premium that I applied in the 21 to 25 WAC of 75 basis points. Just because companies like FactSet and Reuters are going to have that that competitive advantage from being public for longer with institutional investors. And in 26 to 30 WAC, I've lowered that to 50 basis points. I've also ran a sensitivity analysis of the terminal growth rate against these 2 WACs in the slide here. And on top of that, I've done a 2021 price to operating profit multiple. That gave me a valuation of $9.30, a price to earnings multiple that gave me a valuation of $7.10, and an enterprise valued EBITDA that gave me a valuation of $5.75. And I thought it was appropriate to apply 15 times price to free cash flow multiple, which gave me a valuation of $8.85. I've weighted the DCF model the highest because I have the most conviction in my assumptions, and I think it's the most accurate, and all the other valuations are weighted equally. And in doing this, I've reached a valuation, a price target, of $9.42, which represents a 57.5% upside. Now let's talk about risks. I think liquidity is probably the biggest risk that faces MarketWise right now, because insiders still hold about 94% of the shares outstanding after the SPAC merger. And I believe that after about $9.50 a share, at about $10 that area, insiders are going to be able to see benefits from liquidation. And in the filing, there details no restrictions that MarketWise members nor the sponsor are restricted from selling their shares. So past this threshold, insiders, if they become bearish in the company, They could exercise their warrants, and they could sell off in a significant number, and this would obviously reduce the company's market price. I think it's important that at my price target of $9.42, should the stock appreciate to that value, that we realize the gain before it reaches this threshold. COVID-19 is also kind of a risk, considering that MarketWise's rapid billings growth might only be attributable to the unique circumstances provided by the pandemic. And when you consider things like excess government stimulus and stay-at-home orders, people have a lot more time on their hands, a lot more discretionary income, and this might have artificially boosted some of the growth trends from MarketWise in 2020 and 2021. To account for this, I've used some growth numbers from 2018 and 2019, and that coupled with some of my drivers in order to reach my growth values. And then finally, ad rate hikes are another risk, because I think customer acquisition costs might increase as companies put money back into advertising channels that once saw depressed ad rates following the dramatic sales and marketing cost cutting during the pandemic. And to account for this risk, I've steadily increased sales and marketing spend per paid subscriber from about 4% to 8% through fiscal year 2030. Regarding management, Mark Arnold is the CEO with about almost 1% of all shares outstanding. He was appointed in 2017 after 4 years as Director of Business Development for MarketWise's premier brand, Stansberry Research. And before that, he spent 15 years handling M&A and venture capital transactions as a corporate attorney for Edwards Wilman LLP and Holland & Knight LLP. Dale Lynch is the CFO with about 0.62% shares outstanding. And he was appointed in December of 2019 after leading U.S. Silico Holdings through its IPO. And before that, he served more than 6 years as Farmer Mac's Executive Vice President, CFO, and Treasurer. Almost about 5% of all shares outstanding are owned by management and the board. Management's average age is 55, and about 2/3 of the board members are independent directors. If you have any questions or if you'd like a copy of my model, my email is listed on the screen. Thank you.